In this video, we're going to discuss whether or not the SCHD Dividend ETF is finally worth a look in 2026. Hello, YouTube friends. Welcome back to my channel. James here. And sometimes I scroll through YouTube and see people hyping certain stocks or ETFs, and I have to wonder what all the fuss is about. I'm not talking about obvious pump and dumps or the influencers who are clearly being paid to shill certain investments. I mean the stocks and ETFs that just seem to magically enter the investing zeitgeist and stay there. Now, we saw the most famous versions of this during the pandemic with GameStop and AMC. And a few people did hit the jackpot on those, but most ended up with little more than a sick feeling in their stomach. And in those cases, I at least understood the excitement because small caps could theoretically produce a massive payday in a small amount of time. But what about stocks and ETFs that drew tons of attention despite poor performance and little chance of generating a big score? Now, a couple of these have had a pretty decent staying power since the pandemic. Now, I use a video analytics tool for my YouTube channel that tells me how often people are using any given search term. And there's one high dividend ETF that always seems to hang around in spite of the consistently disappointing results. But in the face of an economy being pounded by a US-led trade war and recession calls growing by the day, could it finally be worth a look? Now, about a year and a half ago, I posted a video that, to my surprise, has become the most watched upload on my entire channel. Now, I assumed at the time it would burn bright for a few days before fading into the void. And instead, all this time later, it continues to bring in more views per day than anything I've ever produced. Now, that video was about SCHD, or the Schwab U.S. Dividend Equity ETF. Now, SCHD is a basket of U.S. blue chip companies that have paid out reliable dividends for 10 years or more. Companies also have to pass a number of other quality filters, including standards on dividend growth rate, return on equity, and cash flow to debt. So as of this writing, its top 10 holdings are AbbVie, which is a pharmaceutical company, Lockheed Martin, ConocoPhillips, Cisco Systems, Home Depot, Verizon, Chevron, Altria Group, Amgen, and Coca-Cola. And SCHD's dividend yield is currently around 3.8%, which is pretty good, but its share price is actually down 7% over the past year. So why is everyone still fixated on SCHD a full year after my video went up and in spite of its less than inspiring performance? Let's try and figure that out and decide if it's finally worth a look heading into 2026. Now, one key factor I consider when I'm deciding whether or not to open a position in an ETF is this. Does it outperform the broader market? In other words, would you be better off buying something that passively tracks the S&P 500 and calling it a day? So for nearly all these comparisons, I use three benchmarks: SPY for the S&P 500, QQQ for the Nasdaq, and DIA for the Dow Jones. So how does SCHD stack up to those? Here's the total return for each over the past 3 years according to my TradingView dashboard. So you can see QQQ over 100%, SPY, and then the Dow after that. And then way down at the bottom is SCHD with a 3-year total return of 16%, which is not overly great considering what the others have done. Now, when an investment turns into an online phenomenon without actual performance behind it, that's usually a sign that investors are falling in love with the idea of something and not the results. But having said all that, is it possible that there's a simmering bull case here as the economy wobbles? I think that there might be, and after years of poo-pooing SCHD, I'm taking a nibble here. So let me explain why, but please note, I am not a financial advisor, and this is not financial advice. I'm not telling you to buy or sell anything. I'm simply explaining why I've personally added SCHD to my portfolio recently. Now, I, for one, believe a significant U.S. recession is all but unavoidable at this point. The cost of living crisis, further fueled by tariff levels not seen since the Great Depression, already have lower-tier consumers clutching their wallets. And many businesses have frozen or cut investment and hiring due to uncertainty stemming from chaotic economic policies coming out of the White House. So what's one to do when turbulent times are on the horizon? Well, the higher the risk of a downturn, the more people turn to defensive sectors to cope. And that's what seems to be happening right now. So U.S. T-bills, the most defensive play of all, are on the rise, as are healthcare stocks, which traditionally perform better than other sectors in a recession. So what makes SCHD a good defensive play? Let's count the ways. Now, I've already mentioned a couple of points that make SCHD a recession play, but just to recap, number one, it pays a hefty dividend, which is nice to have if you're holding along through a recession, and it adds a bit of psychological safety, and it's always fun and encouraging to get a notification that a dividend landed in your account. The other part is it looks for quality, so it filters for strong underlying businesses. Good cash flow reduces the chance of running into trouble with debt during a recession, and a high return on equity suggests a robust company that can withstand macroeconomic factors outside of its control. So what else does it have going for it? So let's talk low volatility. Big blue chips that pay dividends tend to be a lot more stable than, say, crypto altcoins or small cap moonshots, and this can remove some of the stress in already trying economic times. There's also easy diversification. Now, lately I've been loading up on fixed income ETFs, financials, healthcare stocks, consumer staples, and real estate in anticipation of a pause in the recent growth stock mania. But I like hunting for companies to invest in every day, so it's fun for me. But for those who just want a diversified ETF that they can set and forget, SCHD might be a good play. It captures some of the sectors I'm hot on right now, and the fund managers do all the work. And there's also the factor of it holds shares in resilient sectors and companies. So when the economy and the market are going nuts, everyone wants to get rich quick. When the economy tanks, people circle the wagons and save their pennies to pay for critical goods and services. So we're talking things like healthcare, medicine, food, toothpaste, cleaning products, stuff that you need to keep you alive. Because SCHD has a presence in some of these areas, it may be more resilient when the purse strings tighten. Now, case in point, during the 2022 tech meltdown, the QQQ saw a max drawdown of around 30%, whereas SCHD only went down about 4%. So is SCHD worth it in 2026? So whether or not a stock or ETF is worth it really depends on the investor. I mean, I have spare change to throw around at stock positions, so I don't mind taking a flyer on it at this price. But as the numbers above demonstrate, in a bear market and recession, pretty much everything is going to go down at least a little bit. So the risk here isn't so much poor returns or fund quality, it's macro factors like the trade war, like inflation, that could destabilize almost everything. And if things were tighter and I had a lot of high interest debt, it would be a no-brainer to start there first instead of the stock market, because that's a guaranteed return on investment. If you're paying, 6, 8, 10, 20% on debt on credit lines or credit cards, this is an easy play to pay that off, and then you don't pay the interest and then start looking for other investments after that. At least that's what I would do in that case. But let me know in the comments. Do you think SCHD is a buy now with a possible recession on the horizon? And tell me, do you think there's actually a recession on the horizon, or can the U.S. economy pull out of what is looking more and more like a tailspin? So thanks everybody again for watching, and please like, subscribe, all that good stuff. Let me know in the comments what you think, and we'll talk to you again soon.